The fall and collapse of banks, the banks that have crashed and what that means for the masses. Video script. Over the past decade, several notable banks have suffered from a fall and collapse due to a variety of factors such as regulatory issues, mismanagement, or global economic turmoil. The fall of these banks has had a significant impact on the masses, as it can result in wider financial and social issues that can affect people's lives. One such example is the 2008 financial crisis, which saw the collapse of several major banks such as Lehman Brothers and Bear Stearns due to heavy investments in subprime mortgages. This financial crisis caused massive unemployment, reduced economic growth, and a significant loss of wealth for individuals and businesses alike. The government had to inject billions of dollars into the banking system to prevent further collapse and stabilize the economy. More recently, the past COVID-19 pandemic has resulted in several banks finding themselves in significant financial trouble. The pandemic created unprecedented economic challenges across the globe, leading to a drastic drop in demand, supply chain disruptions, and widespread unemployment. One of the banks that had a fall and collapse due to the pandemic was Wirecard, a German payment processing provider. In June 2020, Wirecard admitted to a $2.1 billion accounting scandal that resulted in the company filing for insolvency. This news was a significant blow to investors and customers alike, as Wirecard services were used by a plethora of businesses. Another major bank that underwent a collapse in recent years was the British bank, Northern Rock. In 2008, the Northern Rock Bank requested emergency funding from the Bank of England due to the subprime mortgage crisis in the U.S. This crisis led to a run on the bank, with customers withdrawing their savings in masses. Northern Rock eventually became nationalized by the British government, resulting in a significant loss of wealth for its investors. More recently, there have been several regional bank failures that have caused significant concern. In India, the cooperative bank PMC Bank collapsed in 2019, leading to restrictions on deposit withdrawals and protests from customers. Similarly, the Punjab NSs may find it more difficult to access credit, while consumer spending may drop as people become more anxious about their financial situation. In extreme cases, bank failures can even lead to full-blown financial crises and widespread economic recessions. The fall of these banks has had various impacts on the masses, such as job losses, reduced pension values, and decreased trust in financial institutions. The repercussions of banking sector failures can be far-reaching, creating uncertainty and instability that can take years to address fully. A few of the potential impacts that can occur when banks fail. When customers lose their life savings, they may no longer be able to afford basic necessities such as food, shelter, or medical care. This can lead to a declining standard of living and a greater reliance on government assistance programs. The financial repercussions of bank failures can also lead to wider social issues. Rising unemployment rates, increased poverty, and reduced economic growth are just a few of the potential impacts that can occur when banks fail. This can lead to social unrest, political instability, and a general sense of resentment towards the financial institutions that are seen as responsible for the collapse. So, what causes banks to fail? There are many factors that can contribute to a bank's demise, but one of the primary causes is poor risk management. Banks that take on too much risk, or that make risky bets on investments or lending practices, can quickly find themselves in trouble. In some cases, banks can also suffer from fraud or mismanagement. Overall, the fall and collapse of banks is a worrying trend for the masses. As financial institutions become more complex and interconnected, it is increasingly important to take steps to ensure their stability and resilience. This includes effective regulation and monitoring of banks, as well as measures to protect customers and investors in the event of bank failures. By taking these steps, we can help to minimize the potential impacts of bank failures on the masses and the wider economy. In conclusion, the fall and collapse of banks can have a severe impact on the economy and society at large. It is essential to ensure proper regulatory and management practices are in place to prevent further banking failures and to maintain the public's trust in financial institutions.